Today's Talk About It Tuesday question is, I'm a middle-aged man and I'm shifting my focus towards investing in income-producing assets to prepare for retirement. I currently have a high interest savings account, some savings bonds, and a 401k. What are some investment shifts that I should make to prepare to retire in 15 to 20 years? Well, first, I have to applaud the questioner because unfortunately, most people wait way too late to really have an effective investment strategy geared towards retirement. And as much as we try to get younger people to start in their 20s and 30s, I've just found it not something that happens. I think that idea of always having more time down the road or a different priority at that age usually gets in the way. So, with 15 to 20 years, I assume this person's in their mid to late 40s or early 50s, which is a real critical window um, in terms of timing because there's still room for growth as well as production of income. But I want to say this, looking at what the person's portfolio is currently, it really reflects what most people do and the mistakes most people make when you're talking about investing for retirement. So if we look at what they said, they have a high interest savings account, savings bonds, and a 401k. So we have to make a distinction first between saving and investing. And we have to um, clear up the critical mistake that people make. You don't save for retirement, right? It's not about the accumulation of money that you stop working and money stops coming in and you just dwindle it away because you'll never save that much money. Assuming that you have a healthy lifespan, you'll never save enough money to just save and just chew away at the savings as you get older. So it really is about finding an alternative income stream, meaning predominantly passive income streams, so that you don't have to generate income from yourself once you retire from earned or active income. So there has to be a shift in your investing. When you're young and you're able to generate income from yourself, then growth is the strategy for investing. So broad-based index funds, even some high risk or higher risk growth stocks, things that just may have a risk but can grow massive amounts of income, not necessarily, I'm sorry, massive amounts of profit, but not necessarily income itself. But as you get older, you want to make that transition. So with 15 to 20 years, there's actually still room for some growth and for generating passive income streams. So let's just look at the shift. So again, high interest savings is not good for retirement, but it's good for liquidity. It's good for an emergency fund. Keep putting money into your high interest savings up to a point. Um, Savings bonds hedge against inflation a little bit, but they're not good strategies for um, retirement savings or retirement investing. The 401k, I'm not a fan of 401ks, but you already have it, you're in it. So increase the amount that you're putting in there and take advantage of the matching funds from your employer at this point. Um, but now, what other things should you be doing? So if you're talking about shifting towards income, I know dividend income is big for a lot of people, but choosing individual dividend stocks is risky because you only have a small amount, and if that goes, you lose. And having the skill set to choose the right one is difficult. So I would say a U.S. based, broad based dividend paying ETF is a good strategy to start investing in. Also, an international broad based dividend paying ETF is also a good strategy, but not to the same proportion. So I'd say maybe if you're going to use those two as investments, maybe 70% in the U.S. broad-based, 30% in the foreign, in terms of that asset class. If you have 15 to 20 years and you do already have some significant savings and your credit score is good, I would highly suggest getting a rental property. So buy a piece of real estate that you can get rental income from when you retire. So that's a good strategy. Even without getting a property, then you could also consider getting into a REIT. REITs are real estate investment trusts. They pay out quarterly. So that's also a good income producing strategy. If you want to stay in that area, peer-to-peer lending, things like Fundrise and things like that, where you can get some interest income. That's also another strategy. But you also have to remember that you will be collecting Social Security. Maybe you're collecting a pension. So it's how much do you need to really add on to those things that you already are going to have as guaranteed income, to be able to meet the lifestyle requirements that you have to be able to finance that. Um, you can consider, but a little more challenging, a little more risky, starting a business. And when I say business ownership, I'm not talking about being self-employed, not giving yourself another job, but buying a business or starting a business where you're the business owner and other people actually work for you is a consideration. But I think that's much more challenging, and it takes a certain personality type and a certain skill set. So I think the simple thing is, if you have 15 to 20 years, you can still do an index fund, which does pay a little bit of dividends, but definitely the dividend ETFs, US based and an international one. Definitely trying to get some real estate income. Definitely trying to get a little bit of interest income as well, and moving away from uh, the savings bonds. I mean, at this point, I don't think that's a great strategy. The return is so low; it just hedges against inflation. It gives you a little bit of security in case the economy, went down. But uh, the high interest savings, you should consider your emergency fund, broadening that in case we do go into an economic downturn when you're close to retirement or while you're in retirement. So you don't have to sell your assets. You can kind of dip into the emergency fund to carry you until the economy turns around. So that would be my answer in terms of shifting your investment strategy. But you have, great opportunity. 15 to 20 years of growth is phenomenal. Even if you had 10 years of growth, a 10-year window is still a great opportunity for you to make a significant impact. Um, I'd love to hear your thoughts, your strategies, what you're doing currently, even the questions you might have about your own portfolio. But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.